probability models, expected values, and Bayes' formula introduces probability theory as a critical tool in investment analysis and decision-making. Financial markets are inherently uncertain, and probability models help analysts quantify uncertainty and estimate potential outcomes. The topic explains that probability measures the likelihood of events occurring and forms the foundation for forecasting returns, assessing risks, and valuing financial instruments. By assigning probabilities to different scenarios, investors can make more rational decisions under uncertainty. The topic emphasizes that probability concepts are widely used in portfolio management, risk analysis, derivative pricing, and economic forecasting throughout the CFA program and professional investment practice. The topic begins by introducing basic probability concepts and rules. Probabilities range between 0 and 1, where 0 indicates impossibility and 1 represents certainty. The topic explains mutually exclusive events, independent events, and conditional probabilities. Mutually exclusive events cannot occur simultaneously, while independent events do not influence each other's outcomes. Conditional probability measures the likelihood of an event occurring given that another event has already occurred. These concepts are essential because financial outcomes often depend on interconnected market conditions, economic events, and investor behavior. Understanding probability relationships enables analysts to structure investment problems logically and estimate likely future scenarios more accurately. The topic then explains expected value, which represents the weighted average outcome of all possible events using their probabilities as weights. Expected value is fundamental in finance because investors frequently evaluate investments based on expected returns rather than single outcomes. The topic demonstrates how expected returns are calculated by multiplying each possible return by its associated probability and summing the results. Expected value analysis allows investors to compare alternative investments under uncertainty and estimate long-term average outcomes. The topic also introduces variance and standard deviation within probability distributions, helping analysts quantify not only expected returns but also the level of risk surrounding those expectations. A major focus of the topic is the use of probability trees to model sequential investment decisions and uncertain outcomes. Probability trees visually organize multiple possible events and their associated probabilities across different stages. Analysts use these models to estimate expected values, evaluate investment strategies, and assess contingent outcomes. The topic explains that probability trees are especially useful when outcomes depend on prior events or when multiple future scenarios must be considered simultaneously. In financial analysis, probability trees are widely applied in areas such as capital budgeting, credit analysis, option valuation, and scenario analysis because they simplify complex probabilistic relationships into structured analytical frameworks. The topic also introduces Bayes' formula, which updates probabilities when new information becomes available. Bayes' theorem allows analysts to revise prior probabilities into posterior probabilities by incorporating additional evidence or observed outcomes. This process is extremely important in finance because investment decisions are continuously affected by new economic data, earnings announcements, market signals, and geopolitical developments. The topic demonstrates how updated probabilities improve forecasting accuracy and decision-making under uncertainty. Bayes' formula is particularly useful in credit risk analysis, economic forecasting, fraud detection, and investment strategy evaluation because it provides a systematic framework for incorporating new information into probability assessments. The topic emphasizes that probability models and expected value calculations support rational investment decision-making by balancing risk and reward. Investors rarely know future outcomes with certainty, so decisions must be based on estimated probabilities and expected payoffs. The topic highlights that understanding both expected returns and associated risks allows analysts to compare investments more effectively and allocate capital efficiently. Probability-based analysis also forms the basis for modern portfolio theory, derivative pricing models, and quantitative risk management techniques. By combining statistical reasoning with financial judgment, analysts can improve their ability to evaluate uncertain market environments and make more informed recommendations. The key concepts from topic reinforce the importance of probability theory in financial analysis and investment management. The topic demonstrates how probability rules, expected values, variance, probability trees, and Bayes' formula work together to model uncertainty systematically. These tools enable analysts to quantify likely outcomes, update forecasts with new information, and evaluate risk-return trade-offs more effectively. The concepts introduced here provide a strong quantitative foundation for later topics throughout the CFA program, including portfolio management, derivatives, fixed income, and risk analysis. Mastery of probability models equips investment professionals with the analytical skills necessary to navigate uncertain financial markets and support disciplined decision-making.